Welcome, day traders, swingers, scalpers, quants, retailers to Inside Traders. This is a learn out loud deep dive into the world of markets and options, and it's a little bit, of a foray into degenerate gambling, but some would say that's what the markets actually are. We've all seen Wolf of Wall Street, right? So my name is Caleb. I am here with your host, GDT, who is a LLM, and he is reminding us that in the world of options, volatility is a double-edged sword, and it cuts and it cleaves, or whatever, like it gives and it takes. Let's just see what he said. In options trading, volatility can be a double-edged sword by using tools like the black, how do we say it? Skulls or skulls? I want to say skulls. The black skulls model and the Greeks, traders can better understand and manage the risks associated with volatility. And I have learned firsthand the risks of volatility.
I'm only burning my half.
This is what this show's really about, if we're getting into it.
Deserves a better class of criminal, and I'm gonna give it to him.
So let's see what these insiders are doing, right? This for real is the inside trades that the big banks and institutions are making every day. And I'm really interested in it because it's pretty predictive of price. And that's kind of cool. And if you combine it with something like technical analysis, which is pretty predictive of price, and then of various indicators, which, if you listen to the news, this is, risky gambling. Go watch the news. Anyway, we'll circle back to all that. The show is just about how do we get really good at trading options by just learning what all this stuff means. And it's actually not that crazy. The Greeks, people make stuff so complicated, and we are going to demystify all that on this show. And I'm not claiming to be an expert of any kind, but I have spent a lot of time and a embarrassing and ridiculous amount of money to learn a little bit about this world. And now hopefully I can save you some premium as we kind of learn to find good options. But one of the ways that we do that is just by going with the flow, right? So where was the flow going today? It was still going to you guys with your NVIDIA. Wow. So I'm pretty bulled up on NVIDIA right now, and I have zero exposure. And no, of course, I'm not going to do 0-day options on NVIDIA. You really can't win with those. Unless you're buying at the money, if you're buying the volatility, if it even goes up, gets crushed from the decline in uncertainty that your option doesn't even make money either way, puts or calls. You kind of have to have all that stuff figured before. The thing about markets is timing. And that's what another thing we're going to talk about today is timing, because trade timing is everything. Your entry point is everything. It's literally a good exercise, which is impossible for a trader, but just to think about would be, what if you were only allowed to make one trade a day? For whatever reason, you could only place one trade a day. You'd probably be really judicious and careful and selective in every aspect with that trade. And so in that way, that's kind of how we should think about everything. But also, I want to learn how to build systems to interact with the market. And I'm going to share all this once I get it up and running, assuming I don't nuke myself, to be able to compete with the hedge funds and the big players who play with options. And the reason they play with options is because it gives them leverage. And that's what everybody wants, is leverage. And so as much as they can get all of the time. And so they take additional leverage by always playing with, or not playing with, like, you know, how would you describe interacting with the market? Like, I don't even know. So like they're, for whatever reason, they're purchasing calls and puts. I assume it's to make a lot of money. I don't know what else it would be, but like I assume they're trying to make a ton of cash. And so that's why they are taking the riskiest bets imaginable. You're going to hear me say this 1,000 times because until somebody corrects me, I'm going to believe it. All of the market order flow, like volume, is going to these 0-day options. And those are the options that expire this week. And that's because they are extremely reactive. And this is why would you ever go to Vegas when 0-day options exist? I'm not saying I'm not a risky, degenerate gambler. I'm just saying, aren't you too? And if you aren't, okay, whatever. I don't know. So that's what we're here to do less of, though, is like less, irrational, just burning of cash, and more learning to get a feel for these things so that we really understand them through and through. And guess what? It's a finite, set of knowledge or whatever. Like, it's not unlearnable. And so, like, as far as I've been able to glean, the reason the insiders are doing what I just described, these 0-day options, is just to make as much money as possible. So in theory, if you want to trade like an insider, you have to learn to trade 0-day options. And let's see what they bought and sold today. So that's not, they did do a lot of, look at these puts, strike $100. So this is what I like to see is deep in the money puts, because what you kind of can consider that as putting a pile of cash. That's like just in case. What was the date? 9/15. Yeah. So we have these expiry periods. The next big one is 9/15, I think. You can just see where people cluster in options, and 9/15 is like a pretty big cluster. So yeah, like that's what we do on the shows. We just like look at all the options and we explore it all. And I'll share some stuff. Like I said, we're going to talk about timing, but I think it's like really valuable to do two things every day in the world of trying to like learn to trade like these insiders. It's important to trade with the sentiment. So like if you're trading a name, like if you don't want to be bearish on a bullish Tesla day, it's fairly like the smartest money, the most experienced and practiced hands today trading Tesla would have started selling calls right into open and then just like aggressively sold at 340. Because obviously the second we hit 340, we were gonna, where is it? Yeah, boom. Where are we? 340 this morning. Oh yeah, here it is. Yeah, look at that, 240. What did I say? 340? Soon. 240. And so, first of all, it just like shoots out like instantly for 1 second. If you had a limit order there and you got filled, so that'd be good. But I didn't. And so, so then we crash down to these things. So the thing I'm kind of like highlighting with these charts is that there are reliable patterns in the charts. And these line guys, like, the technical guys, they're not just like scrying orbs in the sky. Like there is a real logic to this, to how these charts work. And the logic is all bound in the history, which is readily available. And you can just see, so I just drew these lines 2 seconds ago. Like they're going to connect to different price levels. Not so clear on the 30 minutes. Although what is clear on the 30 minutes is like, look at these bars. Whoops. That is a range. I think I saw that same thing here. Yeah, look at that. Look at that. So like to me, I haven't seen that pattern a lot. I haven't been doing this that long, but that is kind of interesting. So what's the story here? So we're kind of like just going down. Whoa, okay. So we're going down, 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 kind of like just algorithmic selling. Looks like maybe there's going to be a breakout actually here. Because look at this. We get a narrowing of the Bollinger Bands. We get a narrowing of those bands. And then the price, then the, where were we? Oh yeah, so here it is. So look at this narrowing. Yeah, you could see that. I don't know why I can't zoom in. Maybe that will do it. And so you get like this massive green spike up, boom, 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 boom. And we cannot penetrate past the boundary of the Bollinger Band. We can't do it. There's not enough buyers. I don't know why. There's probably just no reason to buy. That's why. And so like, it's kind of like be a default seller unless there's a good reason to buy. Just go by the sentiment. So I was saying there's two things we should do every day. Definitely go by the sentiment. And I don't know, something else probably was really good, but I forgot it. So now I'll have to remember. So anyway, back to the story of Tesla on Friday around whatever o'clock that is. Oh, those are different days, yeah. So 1 p.m. we get, and this is like how the buying stacks up. You get buying in the early morning session, in the morning session, in the afternoon, and into close. A lot into close. So kind of sets the tone for the next day, basically, but not always. So we get this green spike up on noon on Friday, and they're trying to punch through the Bollinger Band, but they can't get it. And then we get this candle down. And what is that going to trigger? That's going to trigger the bulls to be like, okay, one more try. Here we go. Ba-ba. And the sellers are like, fucking not going to happen. Not going to happen. And that's where you get a ton of selling. Because then the buyers are like, well, I'm not going to, like the smart money actually does take their money out then. Now, how could you identify this? You could build an AI to identify it. But like, look at that. An AI could see that easy. This is the kind of stuff that our existing like computer vision and models, I think, would be really good at actually is chart analysis. I'm sure it's already happening. So back to the story of Friday Tesla action. This stuff really gives a little bit of a new flavor to interacting with the markets that I have never capitalized on before, the technical stuff. And the more I get into it, the more I'm like, you really can just see so much history in the candles that are in front of us. So anyway, so what are we on volume? We just get some green volume bars, boom, 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 fail. That's because they tried. And then once you have 2 and especially 3, if you're punching up and it's your third one, it's definitely going to be, okay, now we're retesting support. So then they go all the way down. What's the low on this candle? Oh, this is ARK, not Tesla. That's funny, but it's still the same, just like story or whatever. The low is 40.05. No, 39.32. Oh, this is the candle on ARK. So this is the 200-day moving average candle. That's what this one is. So this is ARK bouncing off. And look at, this is algorithmic. This is a buying program. I'm like, it has to be. Because the second we hit it, that happened. And I should have bought it 1 penny before. And that's what we want to talk about is overcoming the psychology where everyone wants to buy when the price is high, but really you need to buy when the price is low. Problem is, you probably, if you're listening to this show, got liquidated because you're using margin. And like, you only have money when everyone has money, and everyone only has money when the market is up. And so like the trick, the freaking game, the whole thing is, how do you have a ton of cash when the market is down? Like, that's what you want. You want like tons of buying power when the market goes lower. And there's always going to be a reason to retest lower levels. But this stuff costs a lot of money to be able to capitalize on that. So one of the things that you could explore is algorithmic trading. These days, everyone can code, right? Like, let's go to GDT. Boom. Let's see if you can see. So I need that there. Hey GDT. Hey GDT. Write me some code that connects to Tradier API and buys an option contract. There's a thing on my keyboard. Contract. And so he's going to instantly be like, oh, here it is, you know. And then you copy and paste that into a file and save it. And every time you can't figure out what to do, you ask him, that he tells you. And I'll tell you, I've been coding since I was like pretty young, you know, not that young, 20, but like still for a while. I'm 37 now. So anyway, that's a long time. And this LLM, Gamma Delta Theta, my LLM, is a way better engineer than me. Way better. Yeah, like I learn from him all the time. Like, he does it the right way. So look at that. So you just like go, you get an account, you put in your token, you fill out this form, he send it in, boom, done. It would execute. If it was funded, I think this would execute, actually. Yeah, I think this is fully executable. So that, you know, now you can code. Now let's just say I don't know anything. Okay, what do I do with that black blob on the screen? Let's see what he says. It seems like you might be referring to the code snippet I provided. He's a genius. Oh my God. It's crazy. Kind of retarded. I mean, not retired. What? I didn't say that. It's not something I said. And so he's saying, like, set up your environment. Oh, yeah. So this is how you do it. You'll need Node.js installed. What? I don't know anything. How do I, what is a node? I don't know. No. Jumped ahead without properly assessing your familiarity with the technologies involved. Let me take a step back. I hope I'm not confusing my guy. No, I regret this. So, we don't want any bad training in there. But yeah, like going back to what we were talking about, like the green candle on this. So I was saying, like, we want to compete with hedge funds and stuff. How do I go back to chart? Dark pool. Oh, wait. Chart. So yeah, look at this. And then we see the same pattern on Tesla. Interesting, right? Like patterns. We all love patterns. This is all the patterns you could ever want right here. Boom. So yeah, look at these candles. These are like, you will be $40. You will be $40. That's what the market says, dark. You will be $40. Okay. But really, I meant to say this in the beginning. there are no bulls or bears on this show. We just want to, take advantage of the market in all of its ways, not just like, not as a swing trader or a position trader or a quant or a this or that. Like, let's get all 8 of those together and make a freaking system that cannot lose. Okay, here's an idea, right? If you can code. So first of all, you can code because we just showed you how you can code, right? So now you can code. Imagine, this is going to be a little complicated for people who aren't familiar with options, but options represent a group of 100 shares. That's why they're leverage. The leverage is high. It's 100 to 1, and it can nuke you if you're not careful. You really have to be careful with that kind of leverage. And so that's that burning pile of cash. That's option traders, and you're definitely going to get burned. And so, but there could be a system. So like you get this algorithmic trading from the hedge funds. And one of the ways that I think you can play the market is just by predicting what the algorithms will do. Because even if like people cottoned onto that game or whatever, you couldn't reprogram everything in time. Like the market has its own seasons and it's very unique. It's a very unique thing. And it's totally like manipulable a little bit. But also it has its own, like power and drive or whatever, or in both directions, I mean. And a lot of what I think it would be valuable that is cool about looking at the order flow of these traders is why are they doing what they're doing? What time are they buying? At what price are they buying? At what volumes? And this is the most well-informed money spending the most premium. Like, let's go look at the premium just to get an idea what we're dealing with here. So this is the overall flow X, QQQ, and SPY. And we want to sort by premium. See what people are buying. There you have it. This is why Tesla was so bullish. I bet if you remove them, they might actually have had some bearish action. 6 million, highest premium of the day, 6 million into Tesla. In October, 235. So like $3 higher than where they bought it. And I looked at this actually, I remember, and we can look at it on the charts. I remember right where it is. So this guy bought right, where are we? Let's go back. Boom. 230. Yeah, he bought right out of this. Oh yeah, there it is. Where we come out of the hole. Yeah, I can't remember exactly if it was this one or this one, but either way, he bought. Well, we can just look at it. It was like 11.59. Boom. I guess it was this one. Either way, but the point is, like, his buy happened when we had just exited this line. So I drew these blue lines based off of mistakes I made. Look at how well they line up with everything. It's crazy. And so, like, seriously, your instinct with the market is like the exact opposite. So I'll share some trades with you guys and we can learn together how to do better or whatever. Oh shit, you haven't seen any of that. This is why I need that screen. Oh, let me fix this so I have it. Yeah, whatever. Okay. Chart. Sorry, didn't see any of that. That sucks. So speaking of timing, I was playing around with the 240 call today. And this is a really good example. So greens are sells, reds are buys. And this one moment was completely selling at the bottom. Like this was the golden ticket right here. I could have sold this in like 10 seconds later for like $70 a contract instead of 59, like, you know, whatever, a couple $100. And so I still netted out fine on the trade. And a lot of why I'm even like messing around with this contract expires Friday. And if you look, a lot of, you know, it's a very high risk like contract, but I am working on ways to make those type of bets less risky, which I think has to be happening. Like somehow the hedge funds have de-risked this bet because it's the only bet they make. Like, look, this is what the most well-informed of money is doing. So let's see this guy. I mean, that's like a long call. Again, with this, I cannot see. Okay. So tape, boom. Yeah, like this is actually kind of bullish. If you remove that's kind of funny. Yeah, like the action wasn't exactly bearish today. And it would be funny. The hilarious thing would be to get like an upside surprise, which is what would happen. That's what would happen. That's what the market would do. The market is going to do the thing that everyone doesn't think is going to happen because everything else was priced in. And the only thing that is like new and where there's money to be made is stuff people don't know about. And so like that's why timing like matters so much. But also the market is like highly patterned and rhythmic. And so when you enter, when you exit, you can gain an edge just technically speaking, like literally technically speaking, you can gain an edge in your timing. And then also in your behavior. So like going back, let's go look at the sell the bottom. I mean, this was it. I mean, these numbers are like a little bit crazy, but like this is part of a system, so you could like ignore the number. And it made like, I think it basically broke even. But this is about learning how these things react, like, and what are the ranges. Like one of the things that really matters in a contract is how close it is to the money. It's got a Greek attached to it. It's like what is it, Vega? No, I can't think of it right now, but anyway, row. Anyway, that doesn't matter. This is why people make it too complicated. They make it too complicated because it's actually very intuitive. So like an options contract just gives you the option to execute a trade in the future. So you don't want to put up all the capital now. So you're going to say, I think this stock is going to be there by then. There can be down, there can be up, then can be soon, there can be far. It's it. There's nothing else to it. Now, like how you actually execute all that, it gets very complicated. How it's all priced. The pricing of options contracts, pricing and volatility, which is like the same thing, is very, very interesting. In some ways, it's predictable, but it's always like surprising also. And so like basically the price gets activated by moneyness, meaning like how close the contracts bet, like it's called the strike price. Basically, you think Tesla is going to be what by when? The what is the strike price. So if it's like $250, then your strike is $250. And so, yeah, anyway. But this contract, this like had a ton of volume. Let's get that's okay. Let's get the contract. It does have a ton of volume. Yeah. Let's see if it pulls up. Nice. So I guarantee as we pull this up, as I've done this so often, this is going to return all the today's options. Okay, so that's what I'm saying. The smartest money, the most well-informed capital, the most premium in the market is going towards the contracts that expire today. And now, I don't think it has actually much to do with like degeneracy. I think it has a lot more to do with their ability to manage risk. I think that's much more what it has to do with. I think that they found a way to de-risk these contracts. And there are ways you could do this. So GDT kind of told me how they ostensibly do it, but it makes a ton of sense. We'll talk about it in a second. Let's just look at the volume. So people are buying oh wait, no, that's strike. So 240. Hey, that was the highest volume. My call. Well, I contributed a little bit, not that much. Yeah, nothing. I didn't contribute. Oh, that's kind of funny. Yeah, that was my call. 227. No, that wasn't my call then. Strike price. Yeah, that was it. That must have been like the open or something. Maybe I was trading the 250. Oh, I was trading the 250. Yeah, I wrote that wrong in my other thing. Okay, I was trading the 250 call. So yeah, boom, 62 cents. Yeah, maybe this was a better call to trade. I think it actually would have been a better call to trade. I'll tell you why. Because this contract wasn't very reactive. Now, that's because it was too far from the money. As the contract approaches the price the stock is trading at, it acts as like a magnet in reverse or whatever. Anyway, like the price actually, the current price acts as a magnet. That is how it works. So the current price is like tugging on the whole options chain. Below in the case of call options, I guess, yeah, above in the case of puts. And so, yeah, like the closer you get to that magnet, the more it's kind of going to tug, and it's going to have this elasticity until it just like snaps and you're like, boom, and the contract gets activated. And it basically goes from being worth nothing to being worth like triple. And that happens like every day in options land. And so the trick is, how do you find that contract? Well, yeah, everyone already found it, so it tripled. But like, yeah, it's hard to find. This would have been one. This would have tripled. If Tesla had a huge move up, this would have tripled. So the people that were playing this contract, I wasn't in particular. I was just wanted to like have something that moved less. But it was definitely something that I noticed. And anyway, yeah, like there's a reason why all of the volume, these are all expiring today. These are so freaking risky. But so like, let's say you want to be able to take on risk like a hedge fund and take these risky bets or whatever. Well, one of the things that exists is a socket connection, which just means a continuous stream of data to the options trades that are basically happening live. You know, it's like 50 milliseconds or something ridiculous. Maybe it's 1 full second. Either way, it's ridiculous. I think it is well below a second of latency. And it's the literal trades that are coming in. And so you could ask GDT to just sort the trades by their companies and sentiment. And then you could just say the sentiment is, if they're buying a call or selling a put, is bullish. If they're selling a call or if they're buying a call or whatever the opposite of what I just said, then it's the opposite. Basically, selling calls and buying puts is bearish. Buying calls and selling puts is bullish. I never sell puts. That's why it's hard. So unless I'm exiting the trade, I guess. But yeah, like I think the smart money probably does sell puts. I think so. And because when you look at the puts going into the market, it is deep in the money oftentimes. If we go back to Tesla put, let's see, strike. Yeah, that's deep in the money. And no, that's out of the money. Put, what is that? Strike is 212. How can the price be 35 cents? Oh, is that today? Yeah, okay, right. It's today. So the thing is, when you're paying for a contract far in the future, that contract has a ton of extrinsic value, basically time value, and it decays as the contract, progresses through time. In some cases, you benefit from that decay. In the case of a sold call, or I guess a sold put. And so, yeah, this is all the trades are like happening, like this week and next week. And that's because all the extrinsic value is out of the contract and it has all the information that we possibly know. It's like the most equity for the least capital. I think that's why they do it. And so if we really want to compete with them, we got to learn how to place those bets. But I don't think they are bets. I think they have systems. So if we were to look at this, one of the ways that you could manage this, it's very much harder than this, but just to simplify it, there's a concept in options called delta. It's one of the Greeks. Gamma was what I was thinking. Gamma is like moneyness. Gamma's like how close is it to the current stock price. Gamma's the magnet. It's the thing that like is pulling you and then snaps you up, and then that's the contract activating. And so delta is basically the actual nominal, like the dollar change of the contract. So if the contract is worth $100 every day, it's going to be worth 29 cents less. And that's kind of a lot, And why? Because this contract expires on Friday. That's why that's so high. If you were to look at a call like way out of the money, let's go down here. You'd see delta values that are. I was describing theta. And delta. Delta is basically the percentage chance that the contract is gonna expire with value. Delta is just like your chance of winning. Theta is what I was actually describing a second ago, which is how quickly the contracts is decaying. So is this a sold call? So theta decay, no, that's a regular call. Yeah. Theta decay is, so this contract is decaying at 73 cents a day. I mean, theta decay is trending towards 1. So it's going to, everything like ends at 1. Delta ends at 0 or 1. Everything like ends at 0, 1. And so, yeah, anyway, I'm not sure exactly on like how these things expire, but I know that each one of these represents a property of the contract that will really impact its price in different market scenarios. And so all that's complicated, right? Because you have this matrix, and because you can buy or sell a put or a call, and each of them has a strike and an expiration and a gamma, delta, theta, rho, vega, and an implied volatility and open interest and volume and a bid and an ask and a spread and a call size and a sheet and a bullshit that I don't even know about. So it's hard to trade options, but we think we can learn it with AI and the help of YouTube. In the comments, professionals, help us. Tell us what we don't know, for real. And so, yeah, that's like what I see happening in the world is every day the highest volume trades are First of all, let's break this down one more time. So The market is a place where people come to buy and sell in companies. They want to buy and sell these different companies. Sorry, YouTube. Oh, I'm sorry, YouTube. And yeah, so like, oh, how do we make it even more simple? The market is, well, anyway, it doesn't even matter. I don't even want to talk about it. Let's just focus on the volume. The volume, all the market volume is condensed in options trading. All of the options trading are happening on this week's expiring chain. And the probably highest traded contract in the market today was D2 or A1, A2, boom, right there. This Tesla contract. Tesla is like usually the highest volume. If it's not Tesla, it's NVIDIA. And for possibly exciting and cool and interesting, maybe competitive reasons that they might even, who knows, announce at their earnings. Or maybe it's a dumpster fire and like these NVIDIA's holders are going to get freaking nuked. We'll find out. But, I guarantee there's going to be a ton of premium going into NVIDIA, and it's all going to be expiring this week, which is the riskiest contract, but it's because it's the most volatile. And so like, if you want to compete with the smartest money, like we need their tools, we need their systems, we need their ideas. And what we definitely need is their order flow. Oh, that's what we need. We need to know what they're buying and selling, right? Because then we just do whatever they do. And then nobody's caught off guard. And so, yeah, like it had a bearish tilt today, but I think the price action was pretty bullish. What's this call coming into close? QQQs after close, 13 minutes after close, 50 cents. So he's buying what? Spot 360, right at the money. Wow. How much was that? 80 grand. So somebody threw 80 grand into QQQ right at the money. I mean, like here's the thing. What is the Fed going to say? What are they going to say? Everyone's afraid of, do I have them? Maybe I still have them. Mr. Powell, Mr. Chairman. Nope, that was me. Maybe I don't. Hey, there he is. Mr. Chairman. Is he going to be like, hey, we need to shit on the markets and make everything terrible, right? No, it's going to be like, we are going to continue to tighten monetary policy according to the requirements of the system, which is our job. Right? Like, so what is so unexpected about that? Like, what is the market afraid of in that regard? What they're afraid of is that he will do what he said he would do, which is raise rates if inflation is higher. And like, I don't know. I think that the market is this really incredible instrument because it looks forward too far and backwards. Like it doesn't ever look backwards, actually. It only looks forward, but sometimes it looks too far and it like trips over itself in the present, and it has to like revisit things and test things. And so and we see all this in the action. Like you don't have to like even believe a word I'm saying. We can just literally just look through right here, these lines. I drew these for like the day trade, right? And they intersect perfectly with places in history. Look at this clear support. Oh yeah, that's what I wanted to show you. Okay, so let's go on the minute. Boom. And because I was going back to that $6 million of premium going into Tesla that we talked about earlier. So that guy bought like right here, or like right here or right here. I can't remember, but it was at this line. And you want to know why? Like just look at this. This line intersects with this top. So again, let's go through the history. Yesterday, Monday, at the close, the bears are just like, fucking let's go. boom. And then immediately into open. No, is that still the same day? Okay. And then the Bears actually did get some pretty good selling in there. And then boom, just this giant spike up and to 240. And that is the ceiling. And like, we're going to have to punch through 240, or you better believe we're going below 230. You better believe it. You want to know why? Because look, there's nothing backing this price. Everything has to be backed by previous price depending on the period. Boom. Depending on the period. So look, there's not enough price in this. This is the minutely chart. This is what, a week ago? The 15th? Yeah. And so, but again, how did we even get here? Like, let's look at the Tesla story for a bit. So we're like going and we're peeking into earnings. Oh, is that even further back? Oh yeah, there it is. This is earnings euphoria. Boom. Fucking good times. And fun was had for all involved. Unless you held call options into their earnings, because then you got nuked. Because look at this. Boom, just this crash. And what's happening to an options contract there, it's demolished. It's obliterated. I mean, it's obliterated. Like, that's what I'm talking about with option contracts. Like, you have to be so careful. Like, not only is all of the contracts price basically set by the price of the underlying, such that if you have like a 10% decline, that's going to rattle the entire chain down like 20 clicks or whatever. And so like when Tesla 300 call gets rattled, it rattles down to like Tesla 150. And although there are like, it basically has to do with delta. And so like if your delta is like 99 after the stock tanks in an earnings call, that's like pure equity, that you're not paying any premium. And I'm, assuming this is an expiring call or whatever, because you would be paying time premium otherwise, which is why I think those guys, the smart money doesn't pay time premium. They just use the information they have on the day, and they have tools and techniques and processes and knowledge and history and experience to help them improve their returns. And so we want to learn from that. So yeah, so we fall down here on Tesla and we're like, okay, I guess we're okay. Are we okay? And then not really. Oh, that hurts. And then boom, you see this rhythmic selling. So something got pierced, some line got pierced, probably here. What is that? 240. Oh, that's what I'm talking about. And so that's 240.83. 240. No, that's my line. Okay, this is never mind. I was wrong. But 240 is going to line up with a ton of stuff in the past. I mean, any psychological level, 5s and 0s will line up. So, hi. That's my dog, but I don't think you could see him. So like we have this rhythmic selling and kind of consistent selling pressure. And what happens here is it breaks through a technical line. So like, look at how deep this gets penetrated. And then you have this attempt to rally, but look, this rally here, it never gets really above this previous rally. And that's where you have a lower low. And that's what the traders and the freaking smart money is looking for. They're looking for a lower low to buy puts and sell calls. And that's because that's a clear indicator that there's weakness in the stock. And that could be because there's not enough buying pressure and there's generally bearish sentiment. But like, I think the market is default bearish. That's what I think. I think it's bearish by default. The only reason why the sentiment isn't always bearish is if there is a reason to buy. Now, there's always a reason to buy. So it kind of evens out in that way. But like still, I think that's a good thing to think about in terms of how you consider things, is like it's bearish by default. And unless in that time horizon that you're trading within, there's a reason to buy. And the opposite would happen with the technical situation. If things were trending up, then the traders are going to start buying calls. and because we're continuously finding new support levels. So in the Tesla decline, we'll see the full story. Take like a minute. Check this out. So we're kind of limping along. Boom, we pierce through the Bollinger Band, pierces through the line. And then that's a line I made up and drew, but it matches. And so, and it matches with a ton of other history as well. And so then we're kind of like trending up. We have this big run up and a rejection at whatever this is, probably 245. We could zoom in and like get the candle, but just probably 245. And so then because we had that hard rejection, which is going to be at the level of a previous ceiling. Okay, so like, look at this right here. This was where we were finding support previously. On the 10th of August, we found support at 243. And then this is what the technical guys want to see. They want to see support and then higher lows where you're like each low, like in the White Mountain part, like you got the Blue River, you got the White Mountain, the White Mountain's going up. That's what those guys want to see. And then we have this bullish buying pressure upwards to see if we can trigger the algorithmic buying on the way up, because that has to exist as well. And so then, but we don't, we get rejected at 245 and instantly we don't. Here's the thing, you're not going to go right back to where this previous support was. That's not going to happen. You're going to go and test the next support level, always. And so now, sometimes nothing is always in markets, right? There's no rules. But like sometimes what does happen there is like, I think they call that like look below and something. But anyway, sometimes like you'll break through just a little bit, you'll hang out down there just to see what it's like, but then you'll get a ton of buying pressure. And that'll push you back out of the hole. And then that new line becomes support. And you always can think of these two lines as like support and resistance. And you can just look at what side you're on and know that that's your default. So like, where are we at? So it'd be cool to show this giant green candle bursting up. That's what I'm saying is like, okay, so on the 200-day moving average on ARC, 39.32 activated some kind of buying program. And you get this giant green candle just being like, fucking let's go. But then you get this rejection candle at 41.50 is the next one. So with ARC, I mean, it's this line right there. Yeah, it's like 41. It's 41 to 41.50. If ARC wants to do anything, it has to get above 41.50, and it only goes down or trades between that channel. But you could just see the channel. Look at that. I'm just making this stuff up. I don't really know. I'm just looking at what it looks like. And to me, this is on a 30-minute chart. So this is like weeks at a time, right? Yeah. A week at a time. And so like, here's what this giant green candle says. No fucking, or actually it says, yes, let's fucking go. At $39. Yeah, I'll buy ARC all day at $39. This was a great buy so far, right? So like, let's play this story out a little bit more. So let's say this is algorithmic buying program, and it just like, did this giant punch up, which kind of started this rally, but then we got this huge rejection candle at 41.50 down to 40.50. And so now tomorrow will be the decider probably. ARC is going to try to penetrate 41.25 to 41.50. And if it fails to penetrate that, it has to either stay in that channel or more likely go test the 200-day again. And then that would be interesting to see what kind of buying programs. But I'll tell you, I was watching this live when it penetrated because I knew the number, and the buying pressure was insane. I mean, it had to be automatic. Because it was just like such a giant green volume bar, which you could see right there. There it is. I mean, look at that. Like compared to look at that level. It's a big green bar. So that's what we want to see. So like, did that one green bar probably isn't enough to break through 41.50. Now, maybe it will be, I don't know. It depends on how many sellers. But like, see this narrowing? This means something's going to happen. Something's going to happen. It's going to break to the upside. It's going to break to the downside. Something's going to happen. And I'll tell you exactly what's going to happen tomorrow. It's going to test 4150. And if it breaks through, then boom, it snaps back as that is the new resistance, because that will trigger a bunch of buying pressure. Now, it's going to have to close on several confirming candles. Like the algos and the traders are going to want to see like a 5-minute, a 30-minute, maybe a 1 day. There's different things that have to happen, but it's going to line up with a price level, and we're going to see it on this chart. So one of two things happens, obviously one of three things. So it's not very predictive, but like who can say what's going to happen? I'm just going to tell you how it's going to play out. We're going to try to break through 4150. And if we can stay above it for a sustained period of time, that will trigger follow through buyers. If we cannot stay above it for a sustained period of time, or there are no follow-up buyers, then we will have a closing candle below 4150. And that is not a good day to be a candle on ARC. A good time, a minute, assuming we're on the day level, which we're not right now. Let's go back here. And so, yeah, you don't want to be a minutely candle when you just got rejected from 4150 on ARC. Not a good day, not a good interval. So, yeah, that's what they're going to try to do. This guy, see this rocket? He's going to try to go up tomorrow into open. And if he stays above it, probably a couple hours, that is either going to trigger buyers or not. And if there isn't a trigger of buyers, that's where the sellers come in. They're going to test 4150 again. If it penetrates, it can penetrate. It can hang out there for a second. But if it's like 4125, 40, I mean, you know, like anything below 40 is inversion. Anything below 40 is like SR calls in just out of the money expiring today. Because like you just know, like that's based off of the history, that's where we have to go. That's what we have to test. Now, nothing is certain and anything can happen, and it's all just like patterns. So nobody really knows and nobody could say. But this is kind of like makes a ton of sense to me. Where'd the other one go? Maybe we got to zoom out. It makes a ton of sense to me that when you get some recent price history and there's nothing to back it up, then you are in kind of the danger zone. This is what I was trying to show you. So same story with Tesla tomorrow. Same exact story. Tesla is going to, in this, maybe this week determines if we are in if that the last couple of months rally was the beginning of a new bull trend, or was like a relief rally in a larger macro bearish environment, which it's kind of always that anyway. But I do think that actually does determine a lot, because all the technical boundaries were crossed. And so if there are no buyers, that means that there, you know, like will be a decline. And so that's what we want to figure out how to make money from on this show. That should like clear up soon. That is what we want to figure out how to make money on from the show, is not just when markets go up. I think we want to make the most money when markets go down, because the thing that you have to have that nobody has ever, which is why it's happening, is because it's not recursive, but like, you know, it's a feedback loop. You want to have money when the market is at its lowest. Like that's where you want to have a ton of cash. Nobody has cash when the market is low. Like it's only as the market goes up do people like begin to recover. And so I really do maintain that what these hedge funds, let's go see their calls, tape. Let's just look at with the SPY order flow. Yeah, not the right screen, tape. Huh. Oh, there it is. Okay. Let's just look at okay. So overall sentiment is bearish. Let me tell you, these puts, they can make a ton of money. They are, it's all derivatives. So like they're highly leveraged. But yeah, like why are these guys buying puts? Everyone in the world of like normal life, if they do anything in markets, they buy stock, right? These guys, who even knows if they know what a stock is? Let's look at the literal numbers because that will speak for itself. I mean, okay. So the most premium. Now, this actually, I do think is disguising a bearish tilt in the market. Look at this. This is disguising a bearish tilt in the market. So this is why we want to filter out these guys because look at that. Yeah, so it is bearish. There is a bearish tilt. It's crazy. It's crazy. Like you would think that there would be maximum fear. So let's look at this. Above by 65. What is the strike? Yeah. So below. Anyway, the most money is going into like basically these protected puts. This is some kind of hedging. If we go and just again filter these out, but we should look at the puts. That'd be interesting. So boom, 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 buy. Now, give me just the puts. Actually, I'll do that here. Put. Done. Cool. NVIDIA puts coming in hard. 420 put. Wow, like seeing that. At 1690, that's perfect. Hero. Who is it? Let me buy him. Can I buy? Let's get some Chick-fil-A. Wow. 420. 1690, $3.4 million of premium coming in at 244.34. It's perfect. It's perfect. A perfect put done today by some fine gentleman out there with a spare 3.4 million, which is cool. So AMD puts coming in. What are these people doing? They're like buying cash. It's like a put. Okay, so this is what I've been thinking lately. Like a call is like clearly obvious. A call is like, I'm calling it. Tesla 250 buy a year ago. Right? Like I'm calling it. You're just saying what you think that company is going to be worth. A put is kind of like stay put. I'm putting you in place or whatever. Now, in terms of thinking about what these options give you, besides options, is like, so what is a freaking option? Like you have a call and we're all just trying to make money, right? We're all just trying to make money on this. Anyway, there's something that I'm trying to come up with here where it's like cash is like a call option on having more options, and a put is a call option on having more cash. If that makes any sense. It's only going to make sense to like a couple of people probably. I don't know. You could let me try to restate it one more time. Like the reason you want a bunch of cash is so you can buy more calls. Okay? That's why like cash is a call on getting more calls. Okay? Now puts are a call on getting more cash. Like we have to reframe how we're thinking to approach it like these guys. So what are they buying? They're buying the riskiest calls imaginable. What are they putting? They're putting the safest puts imaginable, although they do YOLO puts as well. They do deep calls, they do deep puts, they do it all. They do it all. You want to know why? Because the beauty of options is their ability to express any number of market opinions over any period of time. And so you can say, I'm bearish on Tesla at the 5-minute level, but I'm bullish at the 30-minute level, but I'm bearish at the day, but I'm bullish at the year. Like, and you can have an option for each of those. Now, you'll probably explode yourself if you try to think of all that and manage it all. And that's why we want to learn how these players, what tools do they have, what processes, what systems, what indicators do they look at, what triggers them to buy, why do they sell when they sell, and how can we create using all of the great technology at our disposal, namely artificial fucking intelligence. It exists, it's real, and like you can use it to do stuff. So anyway, like we want to learn to trade like these guys, but you get this big put coming into Disney, Tesla, maybe they have a ton of exposure and they are balancing out the other side of that. Or maybe they know something and they want to take a safe bet. But one thing is for sure, we don't see the sell sides of these trades. Maybe we see them on the other side of the tape, but still, like, they might hold these for like minutes at a time. We have to appreciate this NVIDIA 420 put. So what are they saying? Strike 420. So that's in the money, not deep, but like pretty deep in the money put. And that is going to pay out very, very well if NVIDIA crashes very, very well. Now, if NVIDIA does well, that put isn't going to have a great day. Wait, that put is out of the money. It is out of the money. Yeah, like money, I don't use puts a ton. But yeah, moneyness is like basically how much of the equity premium are you paying for? And so in the case of a put, you're going to have protection all the way up into that price. So I guess that would be out of the money in this case because the price is already $450. So I guess an out of the money put there would be like $500 or whatever. And all this stuff, it matters because like each indicator influences the price, and the price is like, and the timing is everything. And so, we'll wrap up here with the story of Tesla. Like we were kind of back here talking about how so this is the story to earnings. So we get nuked in earnings and then we're kind of limping along, but we trigger something, probably right here, we trigger something and we have some consolidation here. It's like 242 or something. I can't see anything that clear. Yeah, on both sides you can kind of see something, but like something got triggered here clearly, right? Because we began a selling program, and then there is just continuous selling pressure from 230, 240 down to this support where it found at 212. And that was pretty good support. There was something I wanted to highlight here around the candles, where the thing that about Tesla is it could have found support here, same as ARK actually. If you look at these, it does seem a little bit bearish, like because we just came off this huge decline. But if you actually look at the lows on these candles, like the actual low prints on them, they are consecutively higher. And so let's just go back a little bit. So low print on this guy is 229.56. Where are we here? 224. Then we gap down. Where's the 212? Is this it right here? Oh, this is it. I was there. I was right there. So ever since we hit 212.36 was the lowest candle, right? Let's verify that. Lowest candle. Yeah. Well, this is 1 minute chart. Yeah. Lowest candle. So yeah, that could have been the low for Tesla. If it was the low, then that, like kind of sets a new point of resistance. And now that locks in support, so same story as ARK. And it's not the story of the companies, it's the story of the price. And so tomorrow the price is going to try and punch above 240. And guess what? It just barely tried that this morning, and it got a hard rejection. And it tried that on last Tuesday and got a rejection, and the previous Monday. So this is actually just the cap of that previous price. So this is just actually consolidation. So this is why this is such a hard level, because for all of this period of 38 to 40, and what is that, like a couple of days, we're consolidating there, and that's creating like a really strong ceiling for us to punch through, which is why it becomes such a strong support if we can lock in on the other side. And that is only done through continued buying pressure / basically green candles got to stay above that price. So, and that's what it's going to try to do. Like, I'm just telling you, that's what it's going to do. So tomorrow morning, the price of Tesla is going to try to pierce 240. And if it does, and it stays above it for more than a couple hours, then into the afternoon, it's going to be a super freaking crazy run. If it gets rejected off that, then of course it's going to come back down to 230 and try to penetrate. Now, there's a good chance that it actually does find support at 230. There's a pretty good chance of that, but I doubt it. We're going to want to see 212. We want to see how low we can go. The price always wants to see how low it can go. Always, always. It's a game. How low can you go? And the price wants to know. And we want to make money as it happens, because that is what these guys do. These guys, they make money as it happens. And so they sell calls, they buy puts, they print cash on both sides of the trade. And that's freaking cool. And so, like, look at this. You could see this as fear, or you could see this as cash. Like, you know how much this put costs right here? 210. It costs like 20 cents in put money. It's like $20 in real money. But like, it costs like 20 cents in option money. And so, yeah, like, do you know what it would be worth right here? Probably, I don't know, like maybe $500, something like that. Maybe way more, actually. What is it in the money put? Actually, it's probably like $1,000. What is it? Let's just look at it. I think I'm way off in my pricing here. That's why we have to look, because my gut tells me I'm off. Trade. I mean, this is what I'm talking about. Like, they're going to try to pierce 240 tomorrow. It's going to happen. It's my favorite thing that I've figured out in recent times in my attempts to understand the market is, like, I know that statement is true. Well, and if it doesn't happen, then I know what will happen is we'll either bounce around in this channel, or we'll just test lower, because we have to trade the channels. Okay, so at the money put is, yeah, it's like $500. Hey, I was exactly right. Oh, that's awesome. Why did I doubt myself? So, yeah, you could buy that put right here for, let's look at it just to see what that price is, and maybe double celebrate. I'm just kidding. I can't be right twice. But I do look at these numbers a lot, so it wouldn't be that crazy if I was right. So 210 is $29. That's cool. So yeah, you could buy the 210 put right now for $30, and it would be worth $500 if tomorrow we fail to break 250. And if we're at 250, let me just tell you, if we're at 250, you could buy this 230 put for like pennies. It's hard to do. It's hard, but you could do it. And then what's either going to happen is, I would only do this if you were already long, because then you already have like positive delta in working in this is only a hedge. So like, if we do break through 240 and you didn't have exposure to Tesla, I would definitely take exposure right then, right? Because then what's going to happen? We're going to try to break back below. We're going to try blah, blah, blah. But it's not even going to happen. The bull run is going to rip past 250 and lock in. It's going to lock into 250. Or, it's going to go down into the land of opportunity, which it has to become for us in options land. Like, we need to view these declines as the gift. This is where we make money. The rides up are like where we get, we catch up on our laundry or whatever. It's when things that are going down is when we're working hard and we're making money. And that, I believe, but actually really what we want to do is just always follow the order flow. We want to always follow the momentum. I'm just speaking for me in this but anyone on this show, if you're hanging out here, or tell me how I'm wrong, tell me what I'm missing, right? I'm sure I'm missing something. So yeah. That is what's going to happen with Tesla. It could trade, boom, in this channel, but it's going to be that channel. That's what's so cool with markets. It's going to be that channel. And yeah. And just look at the blue here and this giant shift in the probability. The Bollinger Band says probably. It doesn't mean anything. The blue is called the Bollinger Band, and it doesn't mean anything. It just means that the price is probably going to be within the bands, and usually it is. So that's all you can ever say about markets, probably. So probably we're going to try to break 240. If we do, and we hold above it, then that becomes the new support, and it's not even going to get tested because we're going to launch to the 250 in like a tenth of a second. So unless you already held your position at like 238, that's where I would be getting interested is but then, you have to have both sides figured out, because the other side is whatever happens is going to be fast. It's going to be under 10 seconds or whatever, the event of the reaction to whether or not we hold the level. And so if we break below, then we trade here or we go lower. And yeah, literally the price just follows this stuff exactly as you would expect. And it kind of makes sense. But I think what differentiates option traders from YOLOers, which, hey, I like YOLOing, as much as the next guy. So look at how these lines look at now the white and the blue, and look at how the lines, especially just look at the white, line up. Boom, 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 boom. It's so cool. And that means something. Here's what it means. When you are a Tesla bull and you're breaking up to 420, this is a trade. NVIDIA right now, it has to be considered a trade. You want to know why? There is no price history here. There is nothing supporting the price action, which is why whenever the peak finds its top, it does have this attrition, and you see lower lows and then the plunge. And at the bottom of the plunge, you buy. But I held during this bottom of the plunge. I remember this day. And you want to know what? I was broke. I didn't have any money to buy NVIDIA. I wanted to buy NVIDIA at $90 or $100, or what was this Tesla? Yeah, same story happened with NVIDIA, actually. You could have bought NVIDIA for $100 a couple of weeks ago. Nobody has money when the market is down. That is why we got to figure it out. So that's what we're going to be trying to figure out on this show, is how to not repeat the behavioral mistakes that we know are so clearly, I don't know, everyone knows, yeah, buy low, sell high. It's everyone wants to buy low when it's low, but that's when the economy is in a deep recession. That's 2024 Q1 when Coke announces bankruptcy. I'm just kidding. That's never going to happen. But still, the trick is, the whole game is, you make money on both sides of the trade, and you read the indicators and the signals, and mostly you just don't spit into the wind. You know, spitting into the wind is buying a call when everyone is bearish. Spitting into the wind is selling a call at the bottom of the market. And so there are things that we can just learn and avoid to enhance our returns. And I feel like I've made every mistake in the book. And so I'll try to share all that with you guys, and hopefully that brings some value. But if it doesn't, then I know, GDT will, and we'll keep watching, Heath Ledger. We could watch him right now. What else did he say?
Tell your men they work for me now.
Hell yeah.
This is my